Hello. The government loves when you do well and make money, whether that's income or capital gains, because they get to tax you. Today at West Oak Money, I want to talk about capital gains and how that affects you so that you can be aware of the tax burdens that you're going to incur by the decisions that you make. So here we go with Capital Gains 101. What is a capital gain? A capital gain is when you buy an asset and then later on you sell it for more. That's capital gains. It's possible you could have a capital loss. Of course, that would be you buy an asset and it sells for less than you pay. The thing that you only have to pay on is a realized gain or loss, not a one that hasn't happened yet. The government puts these gains in two different categories. When we're talking about ETFs, stocks, or mutual funds, the rules are 1 year and less, then you're paying ordinary income. So whatever your ordinary income tax rate is, that's the tax you'll pay. Usually it's high. If you're talking about long-term gains, in other words, you've held the stock, ETF, or mutual fund for more than a year, then there's three different tax rates based on your adjustable gross income, that being 0, 15, or 20. So the longer you hold an asset, generally the government will charge you less taxes. So you have to know generally what we say, what you paid for it in accounting terms, that is known as your cost basis. And the cost basis can change based on dividends or different lots that you acquire at different times. So just because you bought it 10 years ago at X dollars, there could have been some dividends, or you could have misremembered and you bought that 4 different times throughout the year. So you really need to check your records and the individual lots as you sell them so that you understand the taxes that are going to be owed on those transactions. Now, sometimes losses aren't so bad, because if you have one stock that's gone down and another stock that's gone up, you could sell both of those. You realize a gain and you realize a loss, and those offset. Likewise, you could, if a stock or ETF has gone down, you could sell that, and sometimes those losses could carry over to your future tax years as well. So that's just the idea of, just because the stock market is down does not mean that you do not pay attention till it goes back up. You want to realize sometimes those losses and take what they call tax loss harvesting. So where do gains show up? They show up in ETFs, mutual funds, and stocks. Sometimes you could have a mutual fund stay static in their price, but internally they've been trading up and down. And so you could have a capital gains to be paid on a mutual fund, even though the mutual fund didn't go up. So you want to pay attention to those. Also real estate, and they have different holding periods for things that are considered long-term and short-term gains. So smart habits to pay attention to is buy quality stocks and hold on to them a long time so you minimize your taxes. Check your lots before you sell, and be mindful of the 1 year holding period to get that better tax rate. So to recap, gains are real at the sale, only at the sale, else they're called unrealized gains. Time held changes the tax amount, and be sure to track your cost basis and lots. Thanks.